Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Pattrick Smellie. I'm standing in for Dan Brunskill today, and I'm the managing editor at BusinessDesk. Just in case you are really keen, we have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch100, all one word, SharedLunch100, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. The offer only applies to new BusinessDesk subscribers, I'm afraid, and can only be used once per subscriber and can't be reused with any other discounts. So, before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome back. Also, as a quick reminder, if you have any questions of our guests today, you can ask them in the Ask a Question button down below. That's down the bottom right of the screen, left of the Say Something Nice. Don't leave questions in the discussion area because they're likely to get missed. Please be kind and respectful to our guests and your fellow viewers. Otherwise, we will have to take steps to remove you from the webinar. Don't get yourself in that position. Today, we are joined by Nicholas Bagnall. He's the founder and chief investment officer for Ahumairangi's fund. Welcome, Nicholas.
Thank you.
It's quarterly earnings season in the United States when some of the world's largest and best known companies show us their report card for the last 3 months. And with it being such a turbulent time in the world at the moment, investors are chafing a bit to see how those companies are performing. So Nicholas and I are going to spend a little while talking about what investors might be looking for, what this earnings season might be able to tell us, both about the US and the short and medium-term future. Nicholas, I just wanted to start with a really simple question, though. What is the quarterly earnings season? Why are the US equities so focused on telling us what's up every 3 months? In New Zealand, it's a 6-monthly kind of a deal.
Yeah, well, that's the rules in the US. Companies do have to report quarterly in the United States, as they do in Japan and Germany and a lot of other markets. So every company is producing a quarterly report, a financial update and commentary. Most companies are in March, June, September, December balance dates, but others have different dates. And this is when they reveal. And I'd say in the US, I'm not exactly clear on the differences between the rules, but we have continuous disclosure in New Zealand, so there's 6 monthly reporting, but companies are expected to update the market whenever anything is varying from the outlook that investors might have expected. In the US, they tend to save it more for the quarterly report.
Do you think that a quarterly focus is the most appropriate from an investment point of view?
I think we should all be focusing on the longer term. You know, we tend to use a 15-year time horizon when we're evaluating investments, but quarters are important at showing you trends. So, and if the trend changes, it's going to be, changing every quarter. So, particularly for companies where the market price embodies an expectation of a lot of growth, the first thing that might tell you that growth outlook is changing is a change in the rate of sales growth. So you get this quarterly information, and I guess the art of interpreting it is to work out whether you're getting one-off noise affecting quarterly numbers or whether it's a change in trend.
Yeah. So as we go into this quarterly reporting season, what have we just seen? We've seen rising interest rates, the Fed getting ahead of the US Federal Reserve, the central bank in the United States, trying to get ahead of inflation, very much as is happening in New Zealand, and a lot of discussion as to what a recession actually means in an American context. How are the early results that we're seeing tending to look? Are we in a position yet to have a sense of what the trends are for US companies?
Yes, because we're probably halfway through, more than halfway through the earnings season now. Certainly most of the large companies have already reported. And I think generally it's been pretty good. Things aren't quite as bad as people might have feared in terms of demand conditions are still quite strong. A lot of companies are expressing caution about the outlook. They've had a good quarter. They're not sure what the world has ahead for them. But in the June quarter, they generally haven't seen a lot of slowing demand. You know, some other issues they've had to deal with. US-based companies have had to deal with quite a strong exchange rate, which reduces their earnings and revenues from offshore, and also, of course, you've had strong commodity prices, particularly oil, and generally, there's a lot of exceptions, but on average, companies have been quite resilient. A lot of companies that have faced cost pressures have been able to pass them on in terms of higher prices. There's been a lot of slowing in revenue growth, but not a lot of companies going backwards.
Yeah, I sort of wanted to test you on that a little bit, in the sense that I think the expression I've seen quoted is that better than feared is how some of these results are looking. So there are times when you see a bounce in markets, which might be regarded as a sort of a broadly positive sign. But I guess if expectations are already very weak, are we basically bouncing back to somewhat less weak expectations, or is this actually indicating anything which is a little more positive maybe about the next 6 months than we might have otherwise expected?
Yeah, I mean, I think it is. It is partly just bouncing back to slightly less negative expectations, as you put it. It's and I think possibly investors have in some cases been fearful that numbers would be a bit lower than, say, broker analysts had forecasted. So you've had share prices have come back a long way over the course of this year, which partly reflected what concerns about the outlook, and the outlook isn't necessarily clear yet, but certainly over the quarter, people kept on spending.
Yeah. So, recessions are funny things, or recessionary conditions. We may not be in a recession in the US yet. Maybe you'd like to take a view on that. But there are some sectors which do okay in recessions, and there are some sectors that you can expect to do particularly poorly. When you look across the range of investment opportunities in the United States, are obviously huge. Are there sectors at the moment which you would avoid, like a barge pole, with a barge pole, and others where you'd say, well, actually, it's likely that they are either somewhat recession-proof or may even perform reasonably well in a recessionary environment?
Yeah. Well, there's an interesting question for us, because our investment approach at Te Ahumairangi is to favour low-risk companies, which are often the ones that are less cyclical. So it's not something that's particular to the current environment, but we don't generally invest in, we certainly don't invest heavily in companies that are most vulnerable to a recession. And that tends to be companies that are exposed to the capital cycle, they're selling capital goods and so on. We do have investments in a couple of companies that have exposure to advertising. Advertising spending falls when when companies get less confident about the outlook, or when their profit is under pressure. And you certainly saw that in Meta's result. It had its first ever annual decline in revenues. So I think things like capital spending plans and advertising are the first things to suffer. Also discretionary items, things like buying cars, and people cut back on those if they're concerned about the economy or under pressure.
So you're not heavily exposed to Tesla, for example?
No, we don't own any shares in Tesla. Yeah, it's a good company, but it's very expensive.
Right. Well, I mean, of the big names that we've seen, amongst them, Apple, Amazon, Microsoft, you mentioned Meta. Any standout results that we've seen at this stage? Anything that really surprised you, up or down?
For me, and this is not this is not where you had the strongest market reaction, but Microsoft, it was very resilient. It's still growing at I think 12%, and so it's maintaining strong revenue growth. You saw in the other companies you mentioned. Apple was an interesting one. It did sell a lot of iPhones over the quarter, and reported that it was gaining a lot of market share from people who are switching from Android phones. But one thing that concerns us is the services revenue. That's a more recurring revenue that actually fell sequentially, which is only the second time that's happened in Apple's, or in the last 10 years. And what else did you mention? Amazon, the market really liked that result, but I thought it was very ordinary. Their retail business is really slowing and is becoming more unprofitable. The AWS business, their cloud services, is strong, but it's losing market share to Microsoft's Azure.
Is that because those cloud services are becoming more commoditized, or what's going on there?
No, I mean, it's losing market. I mean, that is still growing strongly. So for Amazon, I think it was 33% growth in the quarter, and for Microsoft it was 40% growth. So that market is still growing very rapidly, and could be multiple sizes as big in the future as it is today. And I guess that's an example of what we were talking before, where you don't want to be too focused on quarterly results, but we don't really know how large that cloud services market will be in the future. It's growing really rapidly, and there's no way of predicting the future that's necessarily a lot better than just extrapolating current trends. So when Amazon sales are growing at 33% in the cloud services business, you can assume that will continue for a few more years, and you've got a much bigger revenue line and much bigger profits. But if we saw that slowing to say 25, then our expectation for what level of sales that business might be achieving in a few years' time could be quite significantly affected. So there's a need. Well, there's not a need, but there's you end up extrapolating those growth rates, and when you don't really know what the ultimate demand for those sorts of services are.
Whereas on the other hand, what I would think of as being the traditional side of the Amazon business, which is basically ordering things online and having them sent to you in the post, is that suffering because consumers are spending less in more uncertain times, or are they facing more competition, or is it just that at some stage that becomes actually a relatively costly and difficult business to run by comparison with AWS?
It does seem to be just that they've gained the market share, that they've now got a position of stable market share, or even losing it. So it's hard to compare with the current result season, because a lot of retailers have not June balance dates, but they either have May or July. So there's not a lot of like-for-like comparisons for the June quarter. But I think that certainly for Amazon's own sales, it is growing slower than the broader retail market. It is still getting quite a bit of growth from the retailers that it provides services to. So it's fulfilling the sale for them. But it certainly isn't gaining market share in the way that it has in the past. And it seems to be making efforts to turn, that's a business that been happy to grow really rapidly without making any real profit for many years. It's trying to make money out of it. It's pushing up the costs of Prime membership. It's putting advertising on the site, and it's doing all of that. And the business is actually going from profitable a year ago to loss making right now. So
that's very interesting. So Amazon's traditional business, if I'm hearing you correctly, has effectively become as mature in terms of its capacity to grow in the things it's always done, without ever having become particularly profitable. It almost makes me wonder.
Sorry, Pattrick, can you repeat that?
It almost sounds as if Amazon's traditional business has grown to the point of market maturity without ever being especially profitable. It almost makes me wonder whether at some stage you might not see a split between Amazon and AWS, because they're really quite different companies.
Yes, you could. I think AWS, even though it's much smaller today in terms of revenues, is by far the most valuable of the two businesses. I think there's a real question mark as to whether whether Amazon's traditional retail business will ever make significant profits, whereas AWS is already making very high margins. It's in a marketplace that really only has 3 providers, and it's the dominant provider. And every day you're seeing examples of companies that are moving away from having their own servers and moving onto the cloud and using the services of either AWS or Azure. So that's a growth business that does appear to have quite a lot of growth ahead of it. Now in the case of Amazon, you are paying for that growth. It's rare to find free growth in the share market, and that's certainly the case with Amazon.
Yeah. I mean, I realise it's not the area that Te Ahumairangi tends to invest in, but I just wonder whether you have a view. There are plenty of other software as a service companies. I mean, the world is awash with software as a service companies of various sorts, most of which are not really in the position that Amazon Web Services is at this stage. They tend to be pre-profit, based on revenue growth, valuation based on future potential. Is this, how would you be thinking about them as an investment at the moment, given that almost any pre-profit high growth company is going to need capital to keep it going over the next 2 or 3 years?
Yeah, it's not really an area that we invest in. So I may be in one sense not the best person to ask. And look, I should also say I'm not a financial advisor, so I'm not allowed to give advice. So I can only make general comments here. But
yes,
yeah. But the market has been paying a very high price for that sort of business, taking a very optimistic view. We struggle when we look at those companies sorts of companies to have enough confidence about their future sales and their future profitability to justify an investment in them. I mean, one thing you would look at if you're investing in pre-profit companies is really, when you're looking at the quarterly results, you're looking at the revenue trends. Are they still achieving strong revenue growth? But also, is revenue outpacing cost? Because the worst thing is if they're selling services that cost a lot to deliver, then you might never get the operating leverage that allows you to turn revenue growth into profit. Now, with software, there's generally a large element of fixed cost. So the expectation, which is built into the share prices, is that as revenues grow, costs will grow a lot slower, and you'll therefore transition from a loss to a profit. But the other difficulty is companies can have a strong market position now, but you never really know what new competition they may face over the next 10 years. So you're buying now in an expectation that current trends will take them to a point of profitability, but maybe when they hit that, they're facing new competition and sort of the new bricks and mortar company, if you like.
Yeah, and I think I asked you before, who's recession proof and who's not, and we talked a lot about who's not. Yeah. Again, not giving specific investment advice or even necessarily talking about particular companies. Where is safe? What does safe look like in this environment?
Yeah, it's companies that will have stable demand if you go into recession. So consumer staples is a good example, that's selling food, things like laundry powder, things that people buy every day, and those sales tend to stay relatively steady even if you go into a recession. So, and the other thing we have seen from that sector in the current reporting season is they seem to be doing, and this is a trend we're seeing outside of the US as well as the US, is that these consumer staple companies are generally able to push on the cost increases they face into prices. So they're maintaining their earnings power, and you'd expect them to do so if we went into a recession. Obviously companies like utilities, owning an electrical network tends to be relatively steady, particularly if returns are regulated. Healthcare tends to be relatively stable in a recession.
Is aged residential care as growing a sector in the US as it is in, say, Australia and New Zealand?
It's certainly not as you don't see the same business models in the US as you do with Ryman, where the company's effectively taking some of the property price gain as part of its business proposition. So you do have some smaller aged care community type businesses, but I don't follow any of them closely. Certainly there are companies that build what they call senior housing and lease it out, but I don't think that's growing as rapidly as it has in New Zealand.
Okay, interesting. And what about either sectors or stocks that are particularly affected by perhaps a sense that the pandemic may not be over, but some of the types of consumables that were very much, masks and PPE gear, types of pharmaceuticals and so forth. Is there any evidence of post-pandemic slump for any sectors at all? And are there any which are particularly looking particularly positive as a result of coming out of pandemic?
Yeah, I think arguably that could be one reason why Amazon sales are slowing, that Amazon was a winner during the pandemic because people bought online rather than going into shops. Now they're buying in shops again, so that shift has slowed. You've also had the some obvious candidates like pathology labs that were doing a lot of PCR testing, that's sort of been replaced by RAT tests and less people being tested overall. The personal protective gear, that became an area of huge profit in late 2000, early 2001, and then you sort of had a market that was oversupplied. But one of the companies we own that's had one of the better results is W.W. Grainger, that supply a whole range of consumables, including personal protective gear, to industrial companies, and they about this time last year took a bit of a hit on that, where they they paid for a lot of inventory and the value of it had come down. But now they've just had a result where revenues were growing at about 20%, and because of the operating leverage in the business, they were achieving something like 70% growth in operating profits. So companies are still buying that stuff. There was a period, I guess, early in the pandemic where they were paying huge prices for it. It's still being consumed, but at lower prices. And some of the trends haven't really changed. Supermarkets are still getting a large share of the retail spend, even though they're not the only shops open anymore.
Thanks, Nicholas. Can we just dig in briefly into your own fund's investment approach? So you've talked a bit about favouring lower risk equities as a key part of your strategy. Why is that? And what does it mean that you expect, and how do you manage for that?
The reason why we prefer that approach is that empirically over time, within the share market, high-risk stocks have not produced better returns than low-risk stocks. And in fact, if you look at the highest risk quintile of stocks, the 20% of stocks that are most risky, they've generally performed worse than the rest of the market. So you've actually had better returns on average historically from investing in low to medium risk stocks. And when we look at the current pricing in the share market, we see that more volatile companies with that are more sensitive to economic conditions, on average, are trading at higher multiples to earnings than more stable companies. So that tells us, looking forward, that the balance of probabilities is that low to medium risk companies might produce better returns than higher risk companies. So that's why we favour investing in the low to middle risk companies. Now, and how we, I guess, classify companies, it's a combination of things. It's looking at both their share price dynamics, how volatile they are, how sensitive their share prices are to general market conditions, but also looking at the fundamentals of the company. Do they have debt? Are they selling into a cyclical industry? How consistent are their earnings over time? Yeah, so it's a range of things we look at, and we're trying to get the best risk-adjusted returns, but while restricting ourselves mainly to those low or average risk companies.
Thanks.
Yeah.
Good. I'm going to turn over to questions from people who are listening in and watching. I wanted to start with this one from Matt, who says, what's your view on the rise of passive and index investing? Do you think that asset managers have historically justified their fees for obtaining alpha?
The rise of passive investing is arguably has been justified because I think active fund managers haven't historically achieved enough performance to justify the fees. And you can certainly look at surveys by the S&P. There's a survey called SPIVA, S-P-I-V-A, where they look at the proportion of fund managers that outperform benchmarks net of fees. And the numbers are quite atrocious. Over long periods of time, the vast majority of fund managers haven't produced returns to justify their fees. So it is very understandable, but I think passive has got to the point where it's creating distortions in how markets are being priced, and that's great in the long term for us, because there's nothing better than finding an attractive investment and understanding that it's attractive because it's not in the indexes that a lot of money follows. If an investment looks attractive and you don't know why, it might be because other investors understand something about that company that you don't. But there's a huge differentiation in market pricing between companies that are overrepresented in benchmark indices versus companies that that are underrepresented. And the firms that construct these indices try and make them representative, but there's always, there's some cut-off point between the company that's included and the company that's not.
Yes, presumably that takes a fair bit of research to pick out those companies which are going to perform well, which you believe are going to perform well, but which aren't in an index yet. Whereas if you're in an exchange-traded fund or some other index tracking vehicle, at least you know you're moving with the market.
Yeah. So look, I think passive funds are a good solution. They're there is a disadvantage for New Zealand investors investing in offshore passive funds because it differs, but they often don't get the deductibility on withholding taxes that would be paid on dividends by the funds, whereas if they invest for a New Zealand fund, they do get that deductibility. Sorry, I was going to make another point. Fees is part of the answer. We try to keep our fee at a level that we think we can perform better than over the long term, but we are very much at the low end of fees for actively managed funds in New Zealand.
I've got a question here from Narai, which I think is driving at the advice that you always hear, which is, hold for the long term, don't react to short-term volatility. As a rule. But asking, should you hold a company for as long as 20 plus years, seeing that not every company does well over time? How should you think about the timeframes over which you do invest?
Yeah, well, you certainly, you wouldn't want to own a share. Well, there's a lot of danger in owning buying a bunch of shares and owning them for 20 years, because what you'll generally find is if you pick 10 shares, one of them will become really valuable. A few others might shrink in value. So you might have started off with 10% weighted in each company, and after a period of time, you become very heavily exposed to a single company, which if it then has a hiccup, you're very much at risk. So I don't think the holding period is important, but I think it's important to sorry, this is a general advice again, general comment, not advice, I should say. But I think it's valuable to have a long-term time horizon when you're considering investments, to say, if I held this for 20 years, how am I going to get my return? And to understand how you get a return from the cash flows that a company will ultimately be delivering to you, rather than buying something because you think you'll be able to sell it to some other investor in a couple of years' time for a higher price, because they would have to do a similar exercise, and it's just a greater fool theory. Someone else will come and buy this off me. So the best form of analysis is to think long term, but that doesn't necessarily mean you should hold long term. Sometimes your analysis might indicate you'll get a good long run return from buying an investment and holding it for 20 years, but if it doubles in share price over the first year, then you might be looking at a much more ordinary return for the next 19 years and want to recycle your money.
Yeah. This goes a little bit to a question from Mohan, which says he read recently, catch a rising star, sell right, but don't chase a falling comet, buy right. Is that wise advice?
I might be misinterpreting the meaning, but it's certainly.
I think it's sort of a let your profits run and
there's
crystallize losses.
Yeah, there's a weak tendency on average over time for momentum to work. So companies, share prices that have done well over a period of about a year tend to be slightly more likely to perform better over the following year, and companies that have done poorly over a period of a year are slightly more likely to underperform over the subsequent year. But the time horizon is important. If you follow sort of 1 week or 1 month trends, there's on average over time, there's more of a reversion tendency. Whatever's performed best over the last day or week or month is more likely to reverse that change than to continue it. But certainly there are a lot of companies that go all the way to zero. So if you keep on buying losers, you could keep on buying more shares each day until it's ultimately worthless, and you don't want to be doing that.
I've got one question here, which I know that you said you don't tend to invest in Asia, but asks.
No. We do invest in Asia.
Oh, okay. Yeah. Well, good. So Phil asks, when investing in a country like Japan, how do you think about companies if managers there are less focused on shareholder value than in, say, the USA? And I think probably important to say, if you don't think that that's, is that even a reasonable proposition?
It is arguably, and a challenge often is how long will this persist? And there are in some ways that Japanese companies are. There's much more of a culture of thinking that their objective is to look after the health of the company rather than the health of shareholder wallets. So that there's a much greater tendency in Japan for companies to retain cash when a US company might be buying back shares or paying dividends, but particularly buying back shares. So, and there's maybe, I think in Japan there's a greater tendency for companies wanting to diversify themselves, so they form a new division and invest in that, whereas the US corporate culture is more, investors can achieve their own diversification, we'll just stick to our knitting. And sometimes you have to discount your valuation, basically assume that companies won't do as good a job with the capital they retain as you might have with a company that is more shareholder focused. So there's a price for everything, and you just need to work out what you're paying. So we own a lot of Japanese banks that are trading at roughly half of their net tangible assets, and we're assuming they'll earn lower returns on invested capital over time and be a bit slower to return money to, they'll return a smaller proportion of profits to shareholders. But even taking account of that, we see better returns from investing in those companies than we might from a bank in somewhere like the US that's trading at a premium to net assets and achieving a slightly higher return on invested capital, but the valuation doesn't give you that buffer.
Yeah. Richard asks, and it may well be that you've covered some of this already, but I'll ask it anyway, saying what are some of the investment thematics, which I presume is different from just how does the economy look, do you consider to be good value in the present market?
I think back to our approach, I think there's an underappreciation of stability, of consistency. So, we in the US we own we have quite an investment in telecommunications companies. They're not growing rapidly, and they in fact didn't have a very good reporting season. But we think the spend on mobile phones will grow at inflation over time, and that will produce very good returns to shareholders simply because it's predictable and you're buying them at a cheap enough price to get a good return. There's arguably not a thematic, the low risk that is a thematic. It's a thematic you can't catch in the US, but I think there's an underappreciation in the rest of the world how some companies will be boosted by the strength of the US dollar. So that hasn't fully come in through the current quarter because the US dollar was stronger at the end of the quarter than it was on average through the quarter. But I mean, if anything, what I would say about the market right now is that it is too theme chasing and insufficiently value chasing. So there's been really a rise of areas of strong growth. The market price is fully reflected.
So in very broad terms, just picking up on that and drawing on our last question here, which relates to the state of the world today, how far do you think we are through the cycle that we're in at the moment, which is largely a reaction to the unwinding of money printing and very large government spending programs, which have kept economies alive during the pandemic? And how big an impact do you think things like the war in Ukraine, the tension which is being created between the United States and China, which is heightening at the moment, how important are they to the current environment? So where are we in the cycle? How much is the cycle being or potentially being affected by changes in those either hot wars or threats of war?
Yeah, I guess I'm probably reasonably agnostic on where we are in the economic cycle right now. I'm not taking a strong view. I think there's probably a balance of risks that we see a recession in most countries, but I'm not treating that as a certainty. I think the war in Ukraine has certainly been a big contributor to the rise in oil prices and to some other commodity prices. And you certainly, this is again looking outside of the US, but you're seeing a lot of uncertainty in Europe, where companies are uncertain of future energy supply, and that's putting a hold on investment plans. Actually, I'm sorry, I'm going to jump to a side. One thematic I should have mentioned in response to the last question is I think there's generally an underappreciation, particularly outside of the US, as to how electricity prices might have to get higher as the world decarbonizes, and that's a thematic that I think is generally undervalued around the world, particularly with not the pure plays, but sort of messy companies that have a lot of exposure to that. But the war in Ukraine is good for those companies as well, because if there's if gas prices go up, the tensions in China, I don't know. I don't know how that's actually affecting corporate activity at the moment. So it's certainly impacting markets, but whether it's really changing a lot about how companies behave, I think. Certainly you are seeing in the US a lot of spending in areas like semiconductors, trying to reduce reliance on China. But I think it is. I think we're at peak noise in terms of Pelosi's visit to Taiwan right now, but it is a risk I really worry about for the next decade, that at some point there's some sort of war involving China and Taiwan, and that any investments or any exposure to China could become almost worthless overnight in the same way it did with Russia. So I think that's a risk that we really need to think about when we're investing around the world, because you saw in this quarterly result round a lot of companies that lost 1 or 2% of sales because of Russia. But if the West stopped trading with China, you'd have a lot of companies losing 40% of sales, or really big numbers, and that could be. That obviously would be very significant.
Becomes a bit unthinkable, really, doesn't it?
Yeah.
I noted that at this stage that the only sanctions on trade between China and Taiwan at the moment appear to relate to sand, biscuits, and fruit.
Yeah.
So let's hope that it stays at about that level. We're bang on 1 o'clock. So thank you, Nicholas. Thank you, everyone, for tuning in. Really appreciate your insights and your time today, Nicholas. For people who are following Shared Lunch, keep an eye on the usual Sharesies social channels for news on next week's episode. And until next time, enjoy the rest of your week. Stay safe.
Thank you.